Right. So when we made the low in December, we actually did get a bit more bullish. In fact, much more bullish, and our target was 27 to 2,800 on a rally. And the idea was that central banks would start to change their communication to, frankly, exactly what they did, being more patient and flexible, simply because in December, my view was they had been far too intransigent with respect to the size of the balance sheet reduction and the pace at which it was going to occur. So now that that's happened, I think that catalyst is behind us. I also think that earnings are starting to roll over, and our thesis about a global growth slowdown has really started to become more pronounced. We saw the PMI data out from Europe. U.S. data wasn't awful, but it is certainly second derivative is changing direction. It is slowing. We had a bad payrolls report a week and change ago. So I think that narrative is gaining steam, and the Fed's not going to be able to act quickly enough to counteract it.
So we're at 2814 on the S&P at the moment. What kind of level do you think is a warranted pullback?
Yeah, so again, at 2,800, we got more bearish, went against us for a touch. My target for the year end officially is 2,400. Which would be about flat on earnings year over year at about a 15 multiple, which I think is frankly reasonable given the trajectory for earnings that we're starting to see. We're starting to see that roll over.
So you expect to see bond yields go lower than their current levels?
Yeah, our call, frankly, since the presidential election in 2016 was for a curve inversion, simply because our view wasn't that fiscal stimulus was going to be enough to catalyze a rise in long yields. I didn't think we'd get the inflation. And since the beginning of this year, and really the beginning of last year, again, we've been calling for an inversion. Now, did I expect 3-month to 10-year to press as low as quickly as it has over the past couple days? It's obviously inverted today. No, I didn't, but we didn't expect an inversion by the end of the year.
Clearly you're bearish on equities if your year-end target is 2,400.
Yeah.
What US exposure do you recommend to your clients?
Well, right now, I don't really recommend any. A few weeks ago, I thought with oil a bit below fair value, that energy was a good place to be. But I think that call is largely done. And I think really this year is about being tactical when you see value present itself. And right now, frankly, pretty much across the board, I'm not all that constructive. That said, the yield curve inversion, as well as loan volumes, have obviously been hard on the banks. And now banks are likely a touch oversold. We have small cap banks down 10% or more this week. That's probably a touch oversold.